ULTY can make a brokerage account feel like payday every week while quietly dismantling the investment that produces those checks. That is the mystery on the table today. How can a fund send out a river of cash while leaving the original investment underwater? The answer is not hidden in the yield headline. It is written in the collapsing share value and in what those payments were actually made of. Today we are dissecting the Yield Max Ultra Option Income Strategy ETF, ticker ULTY, issued by Yield Max. This is not a plain stock fund that happens to pay a generous dividend. It is an actively managed equity and options machine. It takes exposure to a shifting basket of U.S. companies, uses covered call strategies around that exposure, collects option premium, adds dividends from directly held stocks and income from U.S. Treasuries, and sends much of that cash out to shareholders. The official description says the fund seeks monthly income, while its current pay frequency is weekly. Either way, the central design is income now, not maximum long-term appreciation. There is no index listed as its underlying, so investors are not buying a transparent rules-based benchmark and letting it run. They are relying on active portfolio selection, active option decisions, and the manager's judgment about where premium can be harvested. That distinction matters because an option income fund can look like a miraculous dividend stock from the outside. Under the hood, it is closer to a small trading desk packed into an ETF wrapper. Cash enters through several doors, but the payout does not tell you which door it used. Some can be earned income. Some can reflect gains. Some can be capital handed back to the shareholder. Our job is to separate the paycheck from the health of the patient. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold ULTY or any other security. ETFs can lose value, including funds designed for income. Distribution character and strategy details can change, so verify the current prospectus, shareholder reports, distribution notices, and other fund documents directly with the issuer, and consult a qualified professional who understands your circumstances before making a decision. Let's check the vitals as of August 7, 2026. ULTY has $764 million in assets under management. It launched on February 28, 2024. The expense ratio is 1%, which is the price of running an active derivative income portfolio rather than simply holding a low-maintenance market index. The asset class is equity, but that label is only the chassis. The driving experience comes from the options overlay and the manager's choices. The absence of a tracked index means the portfolio can change with the opportunity set. That flexibility can help the manager pursue rich option premiums, but it also means yesterday's exposure may not describe tomorrow's risk. Size provides operational context, not a safety certificate. A substantial asset base can show that investors have embraced the product, but it cannot prevent losses in the underlying stocks, poor option outcomes, or destructive distribution policy. For this fund, the more useful question is not whether people bought tickets. It is whether the engine preserved enough vehicle to keep making the trip. For a buyer looking at ULTY, today, the honest lead number is the 60% current run rate. That uses the latest 4 payments and annualizes them, asking what the investor would collect if those recent payments repeated. The latest distribution was 31 cents per share, and annualizing that single payment mechanically produces 59%. Those measures are close enough to tell the same current income story. The trailing 12-month yield is 106%, but that is a rearview mirror statistic. It includes older payments that were much larger than the current checks. Presenting it as today's available income would be like advertising last year's salary after the pay structure changed. The gap between the trailing record and the current run rate is not a technical footnote. It is evidence that the payout regime has contracted sharply. Even the current rate is extreme. It should be read as a warning to investigate the source and sustainability of the cash, not as a promise of wealth. A distribution yield is cash paid divided by current value. When that denominator has been crushed, the percentage can remain spectacular even while the investor's capital base has suffered. A high rate can therefore describe the speed of cash leaving the fund without proving that the fund is creating equal economic value. Time for the history. The first 4 distribution average was 1,224 cents per share. The latest 4 average is 32 cents, The data states the trend plainly, down from the initial launch period payouts to the latest 4 paid rows. The latest average is only 3% of the first average. That decline explains why the trailing yield and the current run rate tell such different stories. The trailing window still carries the ghost of a richer payout period. The recent window reflects what shareholders are actually receiving now. A buyer cannot deposit the historical average. Only future payments count, and the recent direction says those payments should not be treated as fixed income with a stable coupon. Weekly frequency can make the cash flow feel dependable because something arrives often. Frequency, however, is a calendar choice. Stability is an economic result. Small, frequent deposits can still add up to much less than the early checks, and a distribution can change as option premiums, portfolio values, volatility, realized outcomes, and manager decisions change. The proper mental model is variable trading income, not a bond payment wearing an ETF costume. Now examine net asset value, the cleanest picture of what happened to the fund's capital before distributions are added back. The launch reference price was $200. The latest NAV and price is $27.31, and the NAV return since inception is negative 86%. The path is not a mild drift lower. It is severe capital destruction. The maximum drawdown was negative 87%. That matters because drawdown describes the lived experience between a prior high and a later low. An investor depending on the fund for spending money would have watched the capital base shrink while receiving cash. Selling shares during that decline would lock in additional damage, and reinvesting distributions would expose the returned cash to the same troubled path. A falling NAV also changes the fund's future earning platform. Option premium depends on the positions and exposure the portfolio can support. When the capital base per share is much smaller, even an impressive percentage payout can correspond to a far smaller cash amount. That is exactly why the distribution history belongs beside the NAV chart. The dwindling checks and the dwindling capital are parts of the same story. This does not mean every downward move is caused by a distribution. The underlying equity sleeve can lose value, option positions can sacrifice recoveries, and management choices can hurt. But when an income strategy repeatedly pays out cash while its NAV collapses, the burden of proof shifts. The shareholder needs evidence that the fund is generating durable economic return, not merely converting its own balance sheet into spendable deposits. Distributions change the diagnosis, so we add them back rather than pretending the cash vanished. ULTY has paid $166.20 per share since launch. On a simple distribution-inclusive basis, the return since inception is negative 3%. That is dramatically better than the price-only result, which proves the payouts were economically meaningful. But it is still a loss. This is the crucial distinction between cash flow and return. A shareholder may have received a remarkable pile of cash, yet much of that pile replaced value that disappeared from the shares. If a person spent every payment, the brokerage account could feel productive while the remaining asset withered. If a person reinvested every payment, the result would depend on the timing and reinvestment prices, which this simple calculation does not claim to model. Compared with a plain equity position, ULTY asks the investor to judge success through the combined ledger, remaining NAV plus cash received. The plain position keeps more of its economics inside the share price. This fund deliberately pushes cash outward. Neither presentation changes the basic test. Did the strategy leave the investor with more total value? Here, the supplied answer is no. Here is the machine under the hood. The listed top holdings are Shopify Inc., Shop at 5%, Palantir Technologies Inc., PLTR at 5%, Mercado Libre Inc., Melli at 5%, Comfort Systems USA Inc., Fix at 5%, Robinhood Markets Inc., Hood at 4%, and Caterpillar Inc. CAT at 4%. That is not a sleepy utility portfolio. It is a varied equity basket with businesses that can move sharply for very different reasons. ULTY applies covered call strategies around its portfolio exposure. In plain English, the fund takes equity risk and sells call options, giving option buyers some claim on future upside in exchange for premium paid today. That premium is spendable cash. Dividends from directly held U.S. stocks and income from U.S. treasuries can add to the pool. The fund then uses that pool to support distributions. The appeal is straightforward. Volatile equities can carry richer option premium, so the portfolio may harvest meaningful income without waiting for ordinary corporate dividends. In a flat or choppy market, collecting premium can cushion some weakness and turn turbulence into cash flow. The manager can also alter exposures rather than remain chained to an index. But premium is compensation for accepting a trade-off, not free money. If one of those names surges, a call written against the exposure can limit how much of that rally the fund captures. The fund receives today's rental payment but may surrender part of tomorrow's penthouse view. If the stock falls hard, the premium provides only a limited cushion. It does not erase the equity loss. The portfolio can therefore participate meaningfully in declines while participating incompletely in rebounds. Imagine a holding falls after an earnings surprise. The option premium softens the blow, but the equity exposure can still lose far more than the premium collected. If that same holding then snaps back, an outstanding call can restrain the recovery. What should investors watch from here? Start with the next distribution rows, not the trailing headline. The key question is whether the recent average stabilizes, continues falling, or begins recovering from earned portfolio results rather than a more aggressive capital return. Next, compare every cash payment with the NAV path over the same general period. A healthier pattern would show distributions accompanied by a steadier capital base. Continued deterioration would suggest the fund is still paying shareholders with one hand while taking value away with the other. Read the current holdings and options disclosures. Because the fund is active and has no index benchmark, changes in concentration can materially change the risk profile. Watch whether the portfolio remains spread across distinct businesses or becomes increasingly dependent on a narrow pocket of volatile equities. Inspect distribution notices, shareholder reports, and tax documents for clues about option income, realized gains, dividends, and return of capital. Do not assume every cent has the same source merely because it arrives in the same account. Also track the expense ratio against what the strategy delivers after all cash and capital changes are combined. Finally, match the product to the job. Someone seeking predictable principal and dependable spending cash needs a very different tool from someone knowingly accepting unstable equity outcomes for aggressive variable distributions. The right benchmark is not the biggest yield displayed on a screen. It is whether the fund's total economic result supports the investor's actual need. Cause of death, NAV erosion. That is the assigned verdict, and the evidence is unusually clear. The distributions rescued the experience from catastrophic price loss to a modest total loss, but they did not create a positive result. The payment trend collapsed, the capital base was devastated, and the latest checks bear little resemblance to the launch period cash flow. ULTY is not fraudulent magic, and it is not a conventional income holding. It is an aggressive equity options vehicle that can turn volatility into frequent cash, sometimes at the expense of future appreciation, and sometimes by sending capital back to its owner. For a specialist who fully understands that bargain, the fund may be a tactical instrument. For an everyday investor who sees the yield and imagines a durable paycheck, the anatomy says something much harsher. The lesson is simple. Never diagnose an income ETF by the cash it paid alone. Add the remaining NAV to every distribution, then ask what value survived. In this case, the holder largely received their own capital back, and the machine left less than it started with. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next? And where do you think the real risk is hiding? We read everyone. Thanks for watching.